Welcome back to Algobot, the channel where we break down automated trading strategies for MetaTrader 5, one line of code at a time. I'm your host at Algobot, and today we're exploring an expert advisor called Median Absolute Deviation Reversion. This is a mean reversion strategy built on robust statistics. It uses the median and the median absolute deviation to judge when price has stretched too far from fair value. By the end of this video, you'll understand how it measures that stretch, how it confirms a turn with a candle, and how it manages every trade with a stop and a target. Let's get started. So what exactly is median absolute deviation reversion? At its core, it's a mean reversion strategy. It works from the idea that when price stretches unusually far from a central value, it often drifts back toward that center. What sets it apart is the statistics it uses to define that center and that stretch. Classic reversion tools, like Bollinger Bands or a standard z-score, center price on the arithmetic mean and scale it by the standard deviation. The trouble is that both of those are easily distorted by a single outlier bar. One sharp spike drags the mean toward itself and inflates the band, so the strategy can end up chasing the spike or refusing to fade it. This expert advisor swaps in two of the most outlier-resistant estimators in statistics. It uses the median of recent closes as its fair value center and the median absolute deviation as its measure of spread. Together, they produce a robust z-score that reflects how far price has genuinely stretched in units that a lone spike cannot corrupt. The strategy runs on a single time frame, whichever chart you attach it to, and it reads everything from that time frame's candles. It trades both long and short with distinct, symmetrical rules, and it protects each position with a stop derived from the average true range, while aiming to take profit back at fair value. Because it is designed to fade stretches inside a range, it is particularly suited to range-prone currency crosses on intraday charts. Pairs like Euro against British Pound or Euro against Swiss franc, which often oscillate rather than trend strongly. It's best thought of as a tool for traders who want a disciplined, statistics-driven way to study mean reversion. As always, this is educational information only, not financial advice, and every trade carries the risk of loss. Let's walk through the logic step by step. The expert advisor acts once per closed bar, so it makes a single, calm decision after each candle completes rather than reacting to every tick. On each new bar, it gathers the most recent closes, 40 of them by default, and computes two robust statistics. The first is the median, the middle value of those closes, which becomes the strategy's estimate of fair value. The second is the median absolute deviation, or MAD, which measures how spread out the closes are around that median. Both are chosen because a single violent spike cannot drag them around the way it distorts a simple average and standard deviation. From these, the strategy builds a robust z-score. It takes the current close, subtracts the median, and divides by the median absolute deviation scaled by the constant 1.4826. That constant risk scales MAD so that, for normally distributed data, it lines up with the familiar standard deviation. The result tells the strategy how many robust units price sits away from fair value. Before fading anything, the strategy applies a flatness filter. It splits the window into an older half and a newer half, takes the median of each, and measures the drift between them in the same robust units. If that drift is larger than the FlatnessMax setting, the market is trending and the strategy stands aside, because fading a genuine trend works against a reversion system. Only when the window is flat enough does it look for entries. For a long, the robust z-score must be at or below the negative EntryZ threshold, meaning price is stretched well below fair value, and the just closed candle must be bullish, closing above its open. That bullish candle is the turn confirmation, evidence the stretch is beginning to snap back rather than extend. For a short, the mirror applies, the z-score at or above the positive EntryZ, with a bearish confirmation candle. Risk is handled on every trade. The stop loss is placed a distance of the average true range multiplied by the ATR stop multiple away from entry, below for a long, above for a short, so the stop adapts to current volatility. The take profit is set at the median itself, the fair value that price is expected to revert toward. And there's a second exit. If the robust z-score crosses back through zero while a trade is open, the strategy closes it early, judging that fair value has already been reached. Only one position runs at a time per magic number, so trades never stack. Let's read the actual MetaTrader code the expert advisor runs. At the top are the input parameters you can adjust in the strategy tester. Lookback, set to 40, is the number of closes used for the median and the median absolute deviation. EntryZ, at 2.5, is how many robust z-score units price must stretch before a trade is considered. FlatnessMax, at 1, caps how much drift the window can show and still count as a range. ATR period and ATR stop multiple, 14 and 1.8, size the protective stop, and lots sets the order volume. Below that, the code computes the robust z-score, the closed bar's price minus the median, divided by the scaled median absolute deviation. It also checks whether the freshly closed candle is bullish or bearish. The long signal is true when the z-score is at or below minus EntryZ and the candle is bullish, stretched down, and turning up. The short signal is true when the z-score is at or above plus EntryZ and the candle is bearish, stretched up, and turning down. In the buy block, the entry uses the ask price. The stop loss is placed 1.8 average true range below the entry, and the take profit is set to the median, our fair value. The trade.by call then sends the order. The sell block mirrors it exactly. The entry uses the bid. The stop loss sits 1.8 average true range above. The take profit is again the median, and trade.sell sends the order. Notice how both blocks set the take profit to the same median value. The strategy is always aiming price back to fair value, never chasing a runaway move. 2 clean, symmetrical conditions, 1 for each direction. Let's bring the whole strategy to life on a chart. The upper panel shows price for a range-prone currency cross, and the lower panel shows the strategy's own indicator, the robust z-score built from the median and the median absolute deviation. The dashed line across the price panel marks fair value. The rolling median at around 0.86 that price tends to circle back to. In the lower panel, watch the 2 dash thresholds at plus 2.5 and minus 2.5, our EntryZ, along with the 0 line that represents fair value. Start on the far left. Price is drifting gently lower, and the robust z-score is easing down from around 0. Nothing has stretched far enough yet, so the strategy simply waits and keeps measuring. On the next candle, price slides again, and the z-score deepens past minus 1.5. Still not extreme. Then comes a sharp push lower. The candle closes well below the median line, and the robust z-score plunges into the stretch down zone beneath minus 2.5. On its own, that is not enough. The strategy never fades a falling market blindly. It first checks the flatness filter, comparing the median of the older half of the window with the newer half. Because the wider picture is still a range rather than a strong downtrend, the drift stays small and the filter allows a trade. Now the strategy waits for confirmation. The very next candle opens near the low but closes higher than it opened, a bullish candle, while the z-score is still stretched below minus 2.5. That is the exact condition the code looks for, a market stretch down that is starting to snap back. The buy entry marker appears here. The stop loss is placed below, a distance set by the average true range multiplied by 1.8, and the take profit is set at the median fair value itself. From there, price begins to recover. Candle by candle, it climbs back toward the dashed fair value line, and in the lower panel, the robust z-score lifts from the stretched zone up toward 0. As price reaches the median, the take profit target is met and the long trade closes at fair value. Notice the strategy is not trying to capture a whole trend. It only aims for the return to the middle. Now the mirror image sets up. Price keeps pushing higher, past fair value, and the robust z-score climbs. A strong up candle drives the z-score into the stretched up zone above plus 2.5. Again, the flatness filter confirms the broader window is still balanced, not trending away. On the following candle, price closes lower than it opened, a bearish confirmation candle, while the z-score is still above plus 2.5. The sell entry marker prints here, a market stretched up and beginning to roll over. For this short, the stop loss sits above the entry, once more a distance of the average true range times 1.8, and the take profit again returns to the median. Price then eases back down. The z-score falls from the stretched zone toward 0, and as price touches the fair value line, the take profit target is reached and the short closes. There is one more exit rule worth remembering. Even before price reaches the median, if the robust Z-score crosses back through zero while a trade is open, the strategy closes it, treating fair value as reached. So in both directions, the pattern is the same. Wait for an outlier-resistant stretch, confirm the range and the turning candle, fade back toward the median, and protect the position with an ATR stop. That symmetry between the long and the short side is the heart of this approach. That brings us to the end of our deep dive into the Median Absolute Deviation Reversion Expert Advisor. We've seen how it uses the median and the median absolute deviation to build a robust, outlier-resistant view of fair value, how the flatness filter keeps it fading ranges rather than trends, how a confirmation candle times each entry, and how the ATR stop and median take profit manage every position. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Markets carry real risk, and losses are part of trading. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.